Options are derivatives that give the buyer the right but not the obligation to buy or sell an asset at an agreed future price and date. A buyer of an option will only exercise it if the payoff is greater than 0. For lenders and investors, this occurs when the floor rate is higher than the reference rate. Let's consider an example. An organization will make an upcoming investment of $4 million for 180 days starting in 2 months' time. The organization plans to invest in bank bills based on the bank bill swap rate, and it wants to protect against falling rates. The organization decides to purchase an interest rate floor that matches the investment structure and has a strike rate of 3%. The organization's resulting cash flows under multiple scenarios are as follows. Item 1 is the BBSW rate that applied at maturity of the floor and the start of the actual 180-day investment period. In scenario 1, the actual BBSW is lower than the floor rate. In scenario 2, the actual BBSW matches the floor strike rate of 3%, while in scenario 3, the BBSW is higher than the floor rate. Item 2 is the organization's gross outlay from investing in the money market discount security. The formula for calculating it is as follows. As an example, in scenario 1, the principal amount of $4 million, the actual BBSW of 2.5%, and the 180 days period are applied when calculating the present value of the gross outlay. This comes to $3,951,286. Item 3 is the payoff from the long floor. The floor expires worthless in scenarios 2 and 3 as the BBSW is not lower than the floor rate. The organization simply lets the option lapse. However, in scenario 1, the floor has value and would be exercised by the organization. The formula for calculating the long floor payoff is as follows. In rate terms, this becomes 0.5%, that is 3% less 2.5%. In dollar terms, we need to calculate the present value of the discount security at 2.5% and subtract the present value of the discount security at 3% as shown in the calculation. The present value of the discount security at 2.5%, which is the prevailing BBSW, is calculated as follows, resulting in a present value of $3,951,286. The present value of the discount security at 3%, which is the floor rate, is calculated as shown, resulting in a present value of $3,941,685. The long floor payoff is therefore the difference between the two present values, that is the $3,951,286 less the $3,941,685. The long payoff, therefore, is $9,601. Item 4 is the organization's net outlay, after taking into account the gross outlay and the long floor payoff. In scenario 1, we can see that the net outlay of $3,941,685 matches the net outlay in scenario 2, which is the floor rate. Note that this example has not taken into account any premium paid upfront. Item 5 is the effective investment rate for the organization after taking into account the payoff from the floor. The effective rate in scenario 1 matches that in scenario 2 and highlights how the floor worked to prevent the investment rate falling below 3%. At maturity of the floor, if the BBSW rate is below the strike rate, such as in scenario 1, then the organization will exercise the option and invest at the higher rate of 3%. However, if the BBSW rate is equal to or above the strike rate, such as in scenarios 2 and 3, then the organization will let the option lapse and simply invest at the applicable BBSW rate. This highlights how the interest rate floor has been able to keep the minimum investment at the strike rate of 3%, while still allowing the organization to take advantage of favorable upward movements in interest rates. To recap, lenders and investors can utilize options to hedge against declining interest rates by buying a floor rate. The buyer will only exercise the option if the floor rate exceeds the variable reference rate. The buyer will, however, let the option lapse if the reference rate is lower than the floor rate.